All right. So let's move on to uh, our next subtopic. Uh, I told us I was going to be telling us the reason why beginners fail, right? The reason why beginners fail. Why do beginners fail when it comes to crypto trading? What is the cause of their failure? Why do they fail? And they leave crypto, they get frustrated. Why do people suddenly give up on crypto after probably one or two failures? What could be the reason for that? For me, it's very simple, right? Uh, Traders have there are basically four major factors why beginners fail in cryptocurrency trading. Yeah, there are about four, five. So I'm just going to give us the ones I already have written down. All right, yeah. So I'm going to give us the ones I wrote pretty much down. Now, the number one, if you have your pen or whatever that you use it to jot down, you might want to take the things down, right? In the words of J2 Funny, you take things down, just jot things. Okay. Number one is strategy. Number one is strategy. Your trading strategy. Yes, your trading strategy. Most traders, most beginners, they don't have a they don't have a strategy. They just enter the market, no sense of whatever is going on, no strategy. They just want to make the money and leave. Right? That's what they're after. Let's just make the money and then let's leave. But then, is it all about making the money? If you don't have a strategy for making the money, you will lose more money. Yes. If you don't have a strategy for making that money, you will lose more money. At the end of the day, you end up being frustrated. And at the end of the day, you end up telling people, I'm not a fan of crypto. I'm not a this, I'm not a that. Right? So for you out there, you want to make sure you have a good strategy. Uh, Always watch out for your strategy, right? So let's see. You have to understand the trend of the market. As when we talk about strategy, you have to understand it. Then you need to do fundamental analysis before investing in any token or coin. Yeah, talking about strategy. Talking about strategy. You need to have a strategy. And what makes up a strategy? Understanding the market first, which we've been able to achieve in this crypto academy session. Yes, Crypto 101 was designed to and the market, then then also understand the trend of the market. Yeah, understanding the trend of the market, you get to understand that as we progress. Yeah, as we progress. Yes, I can assure you, as we progress, you get to understand the trend of the market, and then fundamental analysis also makes up your trading strategy. Fundamental analysis. Uh, Fundamental analysis is different from technical analysis. Fundamental analysis involves what the news is saying, the total emotional market sentiment at any particular given time, and all that. It doesn't involve charts and all that, right? When we talk of technical analysis, that's when we start talking about charts, start talking about support, resistance, start talking about your your lines, your drawings, and all that. Okay. So, but for strategy, like I said, I'm telling us why beginners fail in cryptocurrency trading. They don't have a strategy. And what makes up a strategy, like I said, understand the trend of the market. You understand the market first, then you understand the trend of the market, then you also do fundamental analysis, right? Before you invest in any coin or any token, you're going to be investing in. So these are the three things that makes up your your marketing strategy. So another thing is, yeah. So Then also, what constitutes your strategy is history. History. Yes, I'm a fan of history. Before I buy any project, I try to know what has happened to this project before, when it launched, what price did it launch, how did the market react to this particular coin or token 6 months ago, how did the market react to in January or in February 2020 reacted on what was the reaction of market on this token. Now, January 2021, what's the reaction of market on this token? I try to juxtapose them. So these are what makes up your strategy. You look at the previous record of the coin or the token and see whether the token is long term or not. You can tell if a coin or a token project is long term by its history. Yes. If the coin or the token has had a the token also has had a good run, you can be able to predict that okay, this coin has done all it will ever do in the crypto market, right? And then you can now make your decision, right? So if you want 100% success rate in crypto, then another strategy you need is to consult professionals. Yeah, yes, people don't like acknowledging it. People don't like acknowledging it, but it's a strategy. Consulting a professional, consulting is a strategy. Yes, as we are right now, having this live class, I'm teaching you, you're listening, you're learning, you're seeing how I do things, you're seeing how I talk, you're seeing my sentiment, you're hearing my sentiment about the market when I choose to enter, when I choose not to enter, what informs my buying, what informs my selling. You're seeing these things. It is a strategy. Yes, it is making up for your strategy. So consulting a professional like myself, like by statistician, is also a strategy, right? It's a strategy. So now, the second reason why beginners fail in cryptocurrency is because they don't manage their portfolio very well. What do I mean by that? There's what we call the risk and reward. There's what we call risk and reward in crypto trading. I have to make out these notes, right? I have to deliberately calm down and make out this. For some of you, a lot of you are beginners. So if you don't know these things, you might FOMO into the market and FOMO out of the market and lose your money and end up saying, I didn't have a good crypto coach. So I'm trying to be that good crypto coach that will tell you this is the reason why you possibly may fail. So I tell you these reasons so you can avoid them on time. So, right, your risk to reward ratio measures your trading potential profit in a market uptrend. Yes. Your risk to reward ratio measures your trading potential profit in a market uptrend to its possible loss in the case of a market downtrend. What do I mean by that? What I mean is your risk to reward ratio, your R raised to power 3, your 3 R's. What is the measurement of your profit in comparison to your loss. Yes, some person risk 20% of their capital to see if they can make 10% profit. Some person risk 10% of their capital to see if they can make 10% profit. Some person risk 5% of their capital to see if they can make 10% profit or 5% profit. Now, just know that whatever your risk to reward ratio is, it also influences your profit and your loss. For example, if you are risking 10% of your capital, you will not be making as much as the person that is risking 50% of his or her capital. But now, here's the flip side. The person that is risking 50% of his or her capital is also standing at a higher rate of loss. If you can, it's very simple. What I'm trying to say is very simple. What I'm trying to state here is you're risking 10% of your capital, right? And there's another person that is risking 50% of his of you that is risking 10% of your capital. If market has a downtrend, it will only go back down on you a little bit. But the person that is using 50% of their capital, by the time market is going down, it will hit that person well, so that you have to wait for market to recover fully before you can either break even or make profit. I have a case scenario where someone bought Solana. Um, Someone bought Solana when Solana did almost its all-time high last year. Bought at 200 and something. That's when the person bought Solana. And Solana dropped to 91. Yeah, Solana dropped to 91 or 90 something. Now, let's assume that I have $500 and this person also has $500 and we entered that trade. Let's say we both enter that trade, that's Solana trade, right? Um, but then I risk 10% of my capital is I risk $50. Yeah, 10% of 500 is 50. Okay. Now, why this other person risk 50% of his or her capital? Meaning this person bought Solana risking $250, which is 50% of $500. Meanwhile, I myself I risk 10%, which is $50. Now, if Solana is to continue pumping and we are to make 10% each, if I'm making 10% of Solana as profit, um I'm making 10% on my capital, not that on the capital I use, that's 10% on $50, not 10% on the $500. I know if you get, but there's what we call working capital and there's dormant capital. Your working capital is what you risk to enter the market, while your dormant capital is still what is in your account, right? So now let's say I risk 50 and I'm making 10% in a market uptrend. It means 10% is going to give me $5. Now, this person that invested for this $250, which is 50% of his or her account, if that person is making 10%, that person is making how much now? 10% of 250, guys, $25. So I'm making $5, the person is making $25. You can see the gap, right? Now you might want to say, this person that is using 50% is a trader, right? This person is making money. Now imagine a case scenario where market has to now go down. Let's say market doesn't continue on the uptrend and market turns, and I'm making 10% loss. It means I'm losing. This person on the flip side is losing $25. If market goes down by 40%, I'm only losing something reasonable, right, out of it. But this person is losing 40% off. Let's get to my point now. So your risk to reward ratio is very, very, very important. Don't be greedy. There's what we call the fear to greed in. There's a what we call the fear to is like a fuel gauge. It's like a fuel gauge. We use it to gauge the market sentiment at each and every time, or at each and every point in time in the market. Yes, we use the risk, not the risk. No, sorry, the fear to greed. Um, should I use gauge? Yes, we use the fear to greed gauge to see what's going on in the market at a particular given time. So we have the fear. We from left to right. We have fear. We have neutral. We have greed, and we have extreme greed. Yes, we have extreme greed. So normally I play safe, so I avoid extreme greed. If market is going into that mode, it means market is pumping. So extreme greed mode, anything can happen. Market can suddenly go back there or extreme fear. Yeah. Fear or extreme fear. Market can just flip and go to extreme fear. And then you that is at extreme greed and entered market at extreme greed, you will be making serious loss by the time market is going back down to extreme fear or fear. Right? Now, so generally this is what we advise. We advise a 1 to 3 of reward ratio. Yes, 1 is to 3. You understand what I mean by 1 is to 3? Your risk to reward ratio is 1 is to 3. So generally, a 1 is to 3 or greater risk reward ratio is usually favorable for crypto traders to enter meaningful trades. Yes, like I said, I made these notes specially and specifically for you guys. So this 1 to 3 risk to reward ratio implies that the trade will likely potential reward for every 1 unit of an additional risk undertaking. Is big grammar, but let me break it down. We all did mathematics in school. 1:3, 1:2, 1:5, 2:4, right? Now I'm saying that I recommend a 1:3 risk to reward ratio. What this means is for every 3 times potential reward, what it means is every trade you enter or any trade you enter will likely have 3 times the potential reward for every additional 1 unit of risk undertaken. If I'm risking 10% of my capital, I will be taking 3% upwards. Yeah. Some people take 10%, some people take 50%, some people take 5%. I personally take 2%. Yes, for me personally. But the highest I recommend you take is 3%. Yes. Now this is my reason. This is my analysis why you should not be so greedy in the market. If you do 2% daily or every trade, let's say you trade 5 times a day, and each of those trades you do 2%. What does that mean? 2 times 5, 10. Well, is enough. 10% of my entire capital in a day. If I repeat that every day, this is I'm giving you guys one of my multi strategies. This is what guides me in the market. My risk to reward ratio, I'm not greedy. I'm not. At least I try not to be. Trust me, man. Every trader at some point we want to be greedy. Not by the time you're seeing market pumping, my God. And you're missing out. You're saying, my God, I need to buy, I need to buy now. Actually, there are times I get greedy. Yes. I've gotten greedy at times and it paid off. I've gotten greedy at times and it paid off. But like I said, why pursue 10% at a go? Why pursue 50% at a go for just one trade? When you can have the opportunity to trade probably 5 times in a day or 2 times in a day and make your I myself personally I don't even trade too much in a day. Yes. I can come today and I make 2%. I make 2%. If I see that it's okay for me, I remove my hand from the market. I don't continue. Yes. I don't continue. For whatsoever reason. Sorry. I want to work on that. Okay, yeah. I don't continue for whatsoever reason. If I make 2%, 2 times 30, 2 times 30, let's do the math. 2 times 30, that's yeah, every day for 30 days, 2%, that's 60. Right? 2 times 3, 6. 30 times 2, 60. So 60% in a month. Come on, you've tried now. 60% of your capital in a month, you've tried. It's not when you make 100%, 1000% of your capital that you know that you traded or you're a trader or you're an investor. No. There are sometimes it happens like that. There are some coins, some projects that you can enter if you're hodling or even if you're trading and you make boom 400%, 500. But this happens majorly for people that do futures. Yes, I I major on sports trading. I repeat this, please. I major on sport trading, but I don't trade only sports. Yes, I don't trade only sports, right? So I'm telling you, my one of my strategies on sports. One of my strategies on sports is I'm telling you, your risk to reward ratio. I've mentioned about your strategy. I've mentioned about your risk to reward ratio. These are the reasons why people fail, or rather, why beginners fail when it comes to the crypto market, right? So your risk to reward ratio is should be checked. Then avoid trading with high volume. Avoid trading with high volume. All right, let me read out what I wrote here. I said volume totally depends on how much you can take risk. Yes. Your volume depends on your risk. Your volume totally depends on how much risk you can take. So if my kind of person is trading, I know I can afford to take 10% risk on my capital. I know I can afford to take 20%. Some of you can be blessed with capital. Yes. Also, your capital also determines your risk. Yes, if I have a capital of say $5,000, yeah, 5,000 USDT, right? In the crypto market. Let's say I have that capital. Let's say I have 5,000 USDT. My risk at that point will be 5% of my capital. I will not even risk 10%. Yes. Do the math, 5% of 5,000. Talking about USDT, not nine. Right? It's good enough for me. I'll use the 5% and make any money I want to make. 10% of that 5%, I'm sure I know the kind of amount of, yeah, let me just do the math. Right? So we have 5% of 5,000, which is 5 divided by 100 times 5,000. That's 250. So I'm risking $250 out of $5,000, right? And I make um, at that point I will not be going for a higher profit percentage. So I can be going at that point. I can go for 5. Yes, I can go for 5. Now at this point, with this kind of capital, I can go for 5. So 5 times 250, 12.5, right? So a trade can just give me $12.5 and I'm good. Right? One of my he trades with $500 per trade. Yes, that's his own risk. No matter the trade, $500 goes in, and he makes his money, right? He makes his money. So if I enter a trade with this $250, which is 5% of $5,000, that's the source capital, right? So your capital also determines the amount of risk you can take. Yeah, but not just your capital, your greed. Your greed. Yes, your greed. Yes, your greed. Because the people that you want to use that whole this thing and buy. Why? 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 The market will always be there. You don't need to take it all at once. Take it gradually, slowly but surely. Right? Slowly but surely. So, for example, let's say you have 100% fund and you have to invest 40%. See the market position and trend and then invest. If you are a beginner, please, I noted this here. I said, if you are a beginner, invest small amounts. If you see you are getting profit, you can now invest more. Yes. And it is generally favorable that we should put stop loss at 5%. That's for people that trade with stop loss, right? As a sport trader, I don't advise that you close your trade, no matter how downturn the market takes. Yes. No matter the downturn of the market, no matter the do not close your trade. Especially if you're sure of the truth. If the token you're not sure of, yeah, you can take 5% loss. That's what you can risk. Yes. For every trade, uh, you can risk 5% loss. So if you're entering a trade, you just calculate 5% from that trade, 5% down, and then put your stop loss there. That's like I said, if it is a token that you are not sure of, something like Matic now, even if it's going down, I'm not selling off. Yes, I'm not selling off. I leave it there. I leave it there. And any token on Binance that I'm sure of, because like I said, there are tokens that can get unlisted based on their performance. Let's say these tokens they don't do well. Sorry, just give me a moment. Let me attend to something. All right, guys. So let's say these tokens they don't do well. let's say these tokens they do not do well and they can get unlisted. So such tokens, if I enter them on the trade, I can just take my 5% loss and leave. But if these tokens that are sure that are projects that are under institutions are backing them up and so forth and so on, right? I can afford not to close, leave it. So your yeah, where is it? So 5% loss, you can keep it at that. Then anytime don't invest more than 40% of your funds. I noted here, I said we should not invest more than 40% of our funds. So no matter the trade you're going in, make sure you don't give in more than 40%. Why? Now, why am I saying do not use more than 40%? Now, in case market goes down, if you have reserve funds, if you have this mostly works for those that will be using Royal Q. Yes, this will mostly work for those that will be using Royal Q. If you're using Royal Q and market goes down, depending on the setting you give the robot will buy the market at that down level with your reserve funds. Now, once the robot buys the market for you, if the market is going up, it's going to give you 2 times profit than you would have made using normal exchange. Let me explain. Let's say I bought Matic and I bought $20 worth of Matic out of $50 worth of Matic. I bought $20 worth of Matic at 1.6, and Matic dropped to 1.1. Yes, let's say Matic drops to 1.1. That means 0.5 is out of the market, right? Now, on normal exchange, let's say I buy another extra $20 worth of Matic at 1.1, and then Matic climbs back to 1.6. I would have only break even on 1.6. Yes, it will have to go beyond 1% for me to have made my profit. But on Royal Q, on the robot, if market goes down, the robot buys a new position and the robot automatically resets a new profit zone. So if my previous profit zone on the robot was 1.8 and market dropped to 1.1 and the robot buys a new position at 1.1, the robot will now bring my profit zone to 1.3 or 1.4, right? Now, it's using my entire $40 that's consisting of both the first and the second trade and now in the market, right? Now, if the market goes up to hit 1.4, the robot will be giving me profit based on $40, not 20. Meanwhile, on normal exchange, it will be giving you profit based on the recent one you just bought. I don't know if you're getting my point. Please, I don't know if you're getting my point. Follow me. I said, let's say I bought Matic at 1.6 and I bought $20 worth of Matic out of $50, right? And Matic drops to 1.1 on normal exchange like Binance, and I buy with another $20. Now, that last buy, that $20 buy, I'm buying at 1.1, right? But now let's say market hits 1.5 or 1.4. My previous $20 will be on profit, but the first $20 I bought with is still nowhere close to break even. It's still nowhere close to profit, right? But now on the robot, on Royal Q, if I buy Matic at $20 and I buy it at 1.6, and market drops to 1.1, and the robot takes in a new position with another $20 at 1.1. Now, if the market is coming up to 1.4, the robot would give me profit based on $40 cumulative. I'm not getting my point. So I'll not be making, I'll not be waiting for break even. No. It's a new position entirely. That's the benefit of the robot, and also that's the benefit of not using your entire funds for a particular market. Because if you use your entire fund for a particular market, you will not be able to buy again when the market goes down. I don't know if you're getting my point. Jerry, mic check, please confirm if you guys can hear me. Mic check. Anyone out there, please? I need a confirmation. It's already 11:46, so we need to wrap up fast so we can call it a day. Mic check. Anybody? Are we all asleep? Okay.
Yes, sir. I'm hearing you, sir. We are hearing you,
Ifeanyi,
sir.
are you there?
Yes, sir. I'm hearing you,
All
sir.
right, thank you. All right, thank you. You can meet your mic now. All right, so let's continue. Let's continue. So I was saying that the reason why you should not risk more than 40% of your capital to be able to buy back into the market when market goes down. Yes, it gives you a good advantage in the market to make more profit. Yes. After that, the next thing that makes up for people or rather beginners' failure in cryptocurrency, the next item I listed out here is called dollar cost averaging. Yes, this year, dollar cost averaging. I've mentioned this before, right? In one of our previous classes. I think our foremost class that was about a week or 2 weeks ago. A week or 2 weeks ago, I've used this particular term, dollar cost average, this year. But I'm not going to teach you this night. The explanation is much. So I'm going to move it to 102. Yes, it's part of my yeah, let me yeah, it's part of my topic for to 102. So I'm not going to deal on that now. Then the last item I wrote here, which is very important. This one is very important. I've been repeating it since. So, but just let me just repeat it for emphasis sake. Do not, right? Do not panic sell. We call it panic sell. You can say do not sell in panic. Do not panic sell. Anyone, do not sell when market goes south. Do not. My God, this thing has made a lot of persons lose money. Markets will always have a way to come back. What's going on in the market, right? You can see Bitcoin. You can see what's going on in Bitcoin. Let me show you. Let me share my screen now. Let's see what's going on in the market. Um, Let me share my screen. Do not. Anytime market goes down, do not sell off. Anytime market goes down, this is this is BTC, right? This is daily chart. This is the daily chart. Each candle here represents a day. Each candle represents a day. Can you see my screen? Jerry, mic check. Stephanie, confirm if you can see my screen. Mic check.
Yes, we can see your screen, sir. I can see it, sir.
All right, thank you. All right, thank you. So each candle here represents one day. So 3 days ago, that's 27th of February, right? 27th of February. You can see 27th of February, Bitcoin closed at, let me see, let me pick that. Bitcoin closed at 37,640. Yes, around that range. Yes, around that range. Bitcoin closed at 37,640. Right now, let's look at this point. Look at this point now. Also look at this point. Some people, by the time Bitcoin hit 45,000 and they saw it fall back to 34. Yes, let's look at this week here. Sorry, let me show you this week. It's called a week. Yes, it's not a full candle. It was a full candle, but then it started going backwards. So Bitcoin dropped to $34,332. At this point, if you sold, let's say you bought at this point, let's say you bought at 45,000 and Bitcoin fell to $34, sold, you would have made serious loss because now look at the market, look at the market, look at this, look at this. Is this not recovery? This is recovery. So why panic sell? Why panic sell? So I'm always against it. If market is going down and you're a trader, do not FOMO. Yeah, sorry, not FOMO now, panic sell. Sorry. Yes, do not panic sell. It's almost as good as saying, yeah, do not FOMO out. Yes, do not FOMO in, do not FOMO out. Fear of missing out, fear of missing in. FOMO in and also do not FOMO out. So do not panic sell, do not panic sell. This whole movement here is epic. You can see this is somebody's face. Okay, let me show you. This is how we do our analysis. Okay, this is an eye, right? This is an eye. This is an eye. This is a mouth. So this person is seeing a smiling face here, right? So at this point, a lot of persons would have sold off, and this was just what 3 days ago. 3 days ago. Now, as of yesterday being 20, yeah, as of yesterday being uh 28th of February, market started pumping, and this pump started around 1 a.m. It started 1 a.m. of March. Yes, 1st of March, 1 a.m. around 1 2 a.m. That's when this pump started. That's when this pump started. Started from $37,681 and rose to 44. It hit 44 before having a slight drop. So do not panic self. Do not panic self. Right? Um, I think that's my last uh, reason why beginners fail in the market. I've mentioned four reasons. I've mentioned five. I'm going to explain one into one or two. So I've mentioned strategy, lack of strategy. I've mentioned risk to reward ratio. I've mentioned what else have I mentioned? I've mentioned DCA. I've mentioned DCA, right? Yeah, I'm not sure enough now. I've mentioned DCA. I've mentioned avoid trading with high volume. Yeah, avoid trading with high volume. Then I've also mentioned the last one, which is do not sell in panic. Not panic sell. Okay, so that would be all for um reason why beginners fail.